IFRS 16, Leases, a comprehensive overview with examples. Introduction. IFRS 16, the International Financial Reporting Standard on Leases, was introduced by the International Accounting Standards Board, IASB, to bring about significant changes in how companies account for leases. The standard, effective from January 1, 2019, replaces the previous lease accounting standard, IAS 17. IFRS 16 requires lessees to recognize assets and liabilities for almost all leases, fundamentally altering the accounting treatment for leases. Key changes introduced by IFRS 16. 1. Recognition of lease liabilities. Lessees are now required to recognize a liability for future lease payments on their balance sheets. 2. Right of use, ROU, assets. Lessees must recognize a right of use, ROU, asset representing the right to use the underlying leased asset. 3. Income statement presentation. The distinction between finance leases and operating leases, as per IAS 17, is eliminated for lessees. Instead, a single accounting model is applied. IFRS 16 example. Let's consider a practical example to illustrate the impact of IFRS 16 on lessees' financial statements. Scenario: Company XYZ enters into a lease agreement for office space, committing to annual lease payments of $120,000 over 5 years. Under IFRS 16, this lease is classified as a finance lease. Calculation under IFRS 16. 1. Lease liability. Annual lease payments, $120,000. Discount rate, 5%. Present value calculation. \frac 120,001 plus 0.051, plus \frac 120,001 plus 0.052, plus \frac 120,001 plus 0.053, plus \frac 120,001 plus 0.054, plus \frac 120,001 plus 0.055, Calculated present value, $543,373.12. The lessee recognizes a lease liability of $543,373.12 on the balance sheet. 2. Right of use, ROU, asset. The ROU asset is equal to the lease liability, initially recognized at $543,373.12. 3. Annual depreciation expense. The lessee recognizes an annual depreciation expense on the ROU asset, which is amortized over the lease term. If the lease term is 5 years, the annual depreciation expense would be $543,373.12, 5 equals $108,674.62. 4. Interest expense. The interest expense for each year is calculated based on the lease liability at the beginning of the year and the discount rate. The interest expense decreases over time as the lease liability is reduced. The interest expense for the first year would be \frac 543,373.12 times 0.051 equals $27,168.66 . Impact on financial statements. Balance sheet. Lease liability, $543,373.12. ROU asset, $543,373.12. Income statement. Depreciation expense, $108,674.62. Interest expense, $27,168.66. Cash flow statement. Cash outflow for lease payments, $120,000 annually. Conclusion. IFRS 16 has a substantial impact on how lessees account for leases. It brings transparency to the balance sheet by recognizing lease liabilities and ROU assets. Companies need to carefully assess their lease portfolios, understand the financial implications, and ensure compliance with the new standard. The example provided illustrates the calculation and recognition of lease liability, ROU asset, and related expenses under IFRS 16.